Thank you very much, Dirk, for that overly generous introduction, and thank you, Adrian, as well. It's delightful to be participating again in an energy community event. This is something of a cocktail, Dirk, but with a maximum of 25 minutes, it's very much a cocktail that will be taken in moderation. And I'll try and draw the threads together as well. Can I say, first of all, that I will, of course, be speaking today in a purely personal capacity. And my topic is indeed this great financial transition, which is now underway, not just in the European Union, but also around the world at different speeds. And I want to put this transition with the various pieces of legislation and delegated acts and so forth in some kind of context, in some kind of narrative, and then invite us to reflect upon what the ramifications are for, in particular, energy community contracting parties. And I will be as interested in your comments and your questions as anything I have to say. So just a brief overview, in very general terms, the challenge of this financial transition, what the Paris Agreement tells us about the necessary direction of travel, and there's a very strong link between the Paris Agreement and all of the activity of the last 5 years or so. I will focus on what the European Union is doing in this area, although of course I cannot be comprehensive. And I will briefly look at other players, China indeed, but also transnational, international initiatives in this regard. And then move on to how this financial transition, which has really only just gotten underway in the last few years, has collided with the tragic pandemic that the world is still yet to emerge from. And of course, the pandemic is principally a human tragedy, but of course it also has an important impact on the climate transition, and indeed the various stimulus packages around the world are having their own impact. So I'll talk a bit about that and then try and bring us up to date with what the financial transition looks like here in early 2021, and then go on to some implications for the contracting parties. So why are we talking about financial transition in the context of climate change? I want to show you a bit of research from one of the other UN climate committees, the Standing Committee on Finance, which had a go at estimating overall financial stocks and flows. And what we see here, looking at the global stock of financial assets, is that low carbon assets are very much a minority, very much a small proportion of, on the other hand, stranded assets, and on the other hand, real estate assets at risk due to the effects of climate change, etc. So the greening of the stock of finance is really a challenge before us. And then looking at the flows of climate finance, and this is on an annualized basis, we see that although there is very significant investment in renewable energies, the nascent market for green bonds, which has exploded in recent years, this is still less than, for example, ongoing investment in fossil fuels, to say nothing of fossil fuel subsidies. And then, of course, set against that are the actual needs for further energy infrastructure investment, which are not being met. So this is part of the challenge, making finance flows consistent with what the scientists tell us is necessary for dealing with climate change mitigation and adaptation. And when it comes to that challenge, dealing with climate change, the evidence is that multilateral financing and specific so-called climate finance is very important. It's essential, but it is a minority of the financing that is available and the financing that is likely to materialize in the future. So in addition to these very important multilateral and bilateral public financing flows, the greening of private sector investment is absolutely vital if we are to stand any chance of meeting the Paris Agreement's mitigation and adaptation targets. That brings me to the Paris Agreement itself, because in fact, this vital international treaty from 2015 sets 3 long-term goals. One of them is the mitigation goal, the famous 2 degrees and best efforts for 1.5 degrees. The second is the adaptation goal. But then there is this third goal, which I've put here in bold, making finance flows consistent with a pathway towards low greenhouse gas emissions and climate resilient development. So this is one of the fundamental goals of the Paris Agreement. And this was a first. This was the first time in international climate law that a goal for making all finance flows consistent with a climate-friendly future was committed to by the almost universal membership of the Paris Agreement. And of course, with an additional member acceding to that agreement in the last month. So very significant. The Paris Agreement has set the necessary direction of travel, not just for mitigation and adaptation, but for the financial transition which is needed to get us to those goals. And of course, the European Union has been one of the champions, first of all, of achieving the Paris Agreement in the first place, of course, under the presidency of France, but then developing the rule book for the Paris Agreement and implementing the Paris Agreement in a credible way. And of course, that includes the objectives of mitigation, adaptation, and this objective of transforming global finance. So it should not be surprising, of course, that the EU, first of all the Commission, but then with various legislative and non-legislative outcomes accepted by the Council and the Parliament, has been working on this consistently through the Sustainable Finance Framework. I'll talk about some of the main legislative outcomes of that, but also through the more recent European Green Deal. And I remember being in the room in Madrid when this deal was announced to a very curious international audience. And indeed, the elements of the Green Deal which touch upon finance, such as the Just Transition Mechanism and so forth. Now, I'm not going to be talking so much about these public financing mechanisms. I'm going to be talking more about this element here in blue of financing the transition and the role of sustainable finance more broadly, including private finance, in helping us to achieve this transition. Now, this is one of those schematics that only the European Commission can produce, it seems. So I'm not going to take you through the details, but what this scheme suggests to us is the necessity to reform finance, to embed sustainability at every point, whether we are talking about banks, institutional investors, whether we're talking about companies and entities which are originating bonds, etc. All kinds of financial markets, all kinds of financial players and actors. All of these need to be incentivized and assisted with frameworks and with data to make finance more sustainable. And this is the endeavor which has given us the taxonomy regulation, which has given us the work towards a green bond standard and so forth. So these are not isolated pieces of legislation. They're all under this broad rubric of creating a framework to make finance more sustainable. And of course, it is principally addressed at EU actors. But given the global footprint of European financial markets and players, it is a development of international significance and clearly a development of great significance for the energy community contracting parties. So to take some of the outcomes of this sustainable finance work in a little bit more detail, and I'll probably spend the most amount of time on the taxonomy, the regulation for which was adopted last year. Now, the taxonomy is perhaps not so well represented by this word taxonomy. What is this in reality? The taxonomy is a list of investments which are judged to be environmentally sustainable. It has been created in order to give investors and the markets and public authorities, regulators, a credible list of what are the sustainable investments, the so-called green list. It is one of these tools which is combating the problem of greenwashing, where a project proponent or a financial intermediary is claiming that their product or their activity is environmentally sustainable, but really there is no credible data to back that up. It's merely a marketing tool. So the taxonomy is bringing a rigorous set of evaluations to the marketplace, the financial marketplace. And the basic idea is that there are several environmental objectives. Most importantly for the topic of energy, or at least most immediately obvious for the topic of energy, climate mitigation. But there is also adaptation, biodiversity, etc. And as the regulation says, it sets out a criteria for determining whether an economic activity qualifies as environmentally sustainable for the purposes of establishing the degree to which an investment is environmentally sustainable. So the taxonomy looks through the particular financial jargon and the financial structure to the actual activity behind it, the economic activity, and judges that as environmentally sustainable or not. An activity can contribute substantially to environmental objectives. That's of course ideal. It must also do no significant harm to environmental objectives. So, for example, a renewable project also must do no significant harm to, for example, biodiversity, which is key. And such an activity must also meet minimum social safeguards and the technical screening criteria. So the regulation is the headline document, the overall normative framework, but then there are these technical details which are developed by experts and then adopted subsequently through delegated acts. So perhaps we can talk about that in the Q&A if that's of interest, but just to be aware, this is the basic point of the taxonomy. And the regulation is addressed to member states and to the EU, applying the criteria of the taxonomy when dealing with this question of determining economic activities in the context of financial markets. And of course, then if you look through the regulation, it sets out various kinds of transparency, various kinds of reporting requirements. So for environmentally sustainable investments, financial products that hold themselves out as promoting environmental characteristics. So this is, again, addressing the issue of greenwashing. It's not enough anymore, or it will not be enough anymore just to make claims about the environmental virtues of a financial product. It will be necessary in the very near future to compare those claims as against the taxonomy. So again, I won't look at the legislative process that's coming, but this, at least in respect of mitigation and adaptation environmental objectives, will be in force as of January 2022. So this is a development which is coming very soon. And just to give one example how particular activities are treated. And this is from a draft delegated act, so of course it is subject to change. Electricity generation using solar PV. There is a simple description of the activity, construction or operation of generation from solar. The contribution to mitigation is simply the generation of electricity using solar, which is self-explanatory. And then there is a longer list of do no significant harm. And you can see some of those elements there. So this is what the details of the taxonomy will look like for hundreds of different economic activities. So it's a very dense process, but if done well, it creates a very rigorous checklist of investable economic activities from the point of view of environmental sustainability. Now, a couple of other elements of this EU sustainable financing framework. Disclosure. There is a specific regulation on sustainability-related disclosure, which, again, in this case, is addressed to financial market participants, but also to financial advisors, so both to investors and those advising others to invest. And it sets out various requirements for transparency, both as to investments, but also as to their methodology, how they account for questions of environmental sustainability. And this is going to be applying to market participants from March this year, from next month. So this is something which is coming to the market very quickly. And the final piece of legislation that is with us currently is the climate benchmarks regulation. Now, there are many benchmarks in finance. There are many indices. S&P 500 is a good example. In the low carbon space, we have seen a proliferation of indices trying to attract investors with their claims as to the climate mitigation virtues of, let's say, the equities which are included in the index. Now, the EU climate benchmarks, which are established here, again, try to create a credible science-based market standard. And it's done at two different levels. So climate transition benchmark, which takes the current position and essentially improves mitigation outcomes as against the investable universe of the given products. And then a more ambitious Paris-aligned benchmark, which has to be aligned with the 1.5 degrees goal of the Paris Agreement. So perhaps benchmarks is a rather niche topic, but it's very important for investors, institutional investors and retail investors which are looking to put their money into sustainable investments. And it is hoped that these two benchmarks will enable investors to do just that. And then as well, there is current work, ongoing work to develop an EU green bond standard. And this would aim to be more rigorous than the current, essentially self-regulatory standards from green bonds currently in the marketplace. Of course, bonds are a very important way for both sovereigns and corporations to raise money through the issuance of debt. And the EU Green Bond Standard, as it's envisaged, will build upon the EU taxonomy. It will utilize the taxonomy when scrutinizing whether the use of proceeds of the bond, essentially what the project will be doing with the money, is consistent with the taxonomy or not. But this is an ongoing process. This has not yet been completed. So that's the EU. A lot happening. As Dirk said, the EU is very much a leader here. But the EU is far from alone. And I think it's fair to say that all the other major economies in the world are addressing this challenge of greening finance flows in their own way. China, for example, has been working on so-called green finance for more than a decade, developing criteria to screen the environmental sustainability of financial products from debt to equity right through the system. Now, this is done in the context of their political and economic system. It's very different to the EU system. But if we look at Chinese external impact, we can say that their overseas financing through the Belt and Road Initiative may well be on the cusp of change. The Belt and Road Initiative has become perhaps the greatest financier of fossil fuel infrastructure in the world in the last few years, in the last less than a decade. However, China, of course, has attracted a great deal of criticism for this. Parties have pointed to the inconsistency between this financing and China's domestic climate ambitions. So it is interesting that in the last year, 2020, it was the first year when there was more new financing for renewable energy through the Belt and Road than for fossil fuels. There is also a market reduction in overall Chinese overseas financing for energy in total. There are various greening the Belt and Road projects. Now, it's not clear what all of this will come to, but it is clear that there is a question mark over the future of China as a major and dependable financier of fossil fuel investment abroad. Now, very briefly, because I realize I'm running out of time, in addition to all the projects happening in particular countries and in the EU, there are various transnational initiatives on every aspect of green finance, from central banks to bonds to stock exchanges. There is a challenge of competing and proliferating standards. There is a need for consistency. Hopefully the EU Sustainable Finance Framework will help with that. But it is clear that the markets are demanding and policymakers are pushing the greening of finance through a range of different mechanisms. Now, what is the impact of the pandemic? Massive stimulus announced principally by developed countries, but also others. Out of over $4 trillion of stimulus, only a minority, substantial minority, is dedicated to environmentally relevant funding. There is interesting research that suggests that some stimulus packages are doing more harm than good, others are doing more good than harm, but it is overall a mixed picture. And for our purposes, the EU, through its stimulus spending, is a major contributor to environmental outcomes. If we look at the overall package, we see that the EU has committed to at least 37% of resources for climate action and environmental sustainability. So globally, pandemic stimulus is a mixed picture. In the context of the EU, I think it's fair to say that the pandemic recovery package is accelerating, or at least it has the potential to accelerate the financial transition to climate consistency within the European Union. So where does all of this leave us in early 2021? I think it's very interesting to show that even with the massive shocks of the pandemic, sustainable debt categories continued to grow through 2020. And if you look at performance, you can see that green bonds are actually beating the universe of bonds generally. So this asset class has been tested, it continues to perform. And of course, it's not all just about debt. If you look at funds management, the amount of assets going into ESG, environmental and social and governance mandated funds continues to grow. Obviously, Europe is the leader here as well. A lot of rebranding to ESG from funds. So again, we need to be careful of greenwashing, but overall this is a positive sign. And then of course, in the background, you have carbon pricing. You have a growing proportion of global emissions covered by either a carbon tax or emissions trading scheme around the world. You see a massive rally in the price of carbon credits in the European Union. And of course, it's not all about the European Union. Further developments expected in the carbon pricing space in 2021, which I can't really go into detail here. And then, of course, as you have higher costs of carbon in certain jurisdictions, the necessity for carbon border adjustments to prevent unfair competition becomes ever greater. So this is not just on the agenda in the European Union. It's very interesting to see that the Biden administration has promised very similar things in its own election campaign. So finally, what are the consequences, implications, and I think it's fair to say the opportunities for contracting parties? The transition to sustainable finance has accelerated and continues to do so even through the pandemic. The corollary to that is that the pressure from both the markets and official sectors on fossil fuel financing continues to increase as well. There are more investors with sustainability mandates, and frankly, the return from sustainable assets is ever more competitive as well, as we've seen in the case of green bonds. The question mark over whether there is a reliable lender of last resort regarding fossil fuels is very much there before us, as I hope I've alluded to. And then, of course, when you look at the implementation of the energy community acquis, if you look at the development of robust 2030 targets, national energy and climate plans, there is the prospect of greater support, not just, of course, from public finance, which is necessary and important, but also from the markets themselves, as they continue to be further incentivized by legislation of the type that we've discussed, but also as they see the writing on the wall and continue to look for investable assets, financiable projects which have some kind of sustainability virtue to them. So I'll end it there. I'm ending here with a photo from Lake Ochrid, which is where I participated in the summer school, and of course it was a wonderful event, and it's nice to look back at a real summer as well. So thank you for your time, and I very much look forward to the discussion.